So a very interesting day today in the crude oil markets, and I got some emails from students saying, crude oil fell negative at many delivery points. It printed at 1 cent at the CME, the front month May contract. Could we make money? Could anyone make money at this by buying the oil and storing it, right, and selling it later? So, and it's great that students are thinking about this. So I figured I'd answer, do a quick video and answer. So the short of it is no, you can't profit off of that. And the reason being is, you're asking yourself, why is oil so low, right? So let's go in and look at what happened and why oil fell so dramatically today. So the idea is first to keep in mind what fell today. Was oil for on the CME. This is the May contract, which actually has a termination of trading tomorrow. So the termination of trading is the 25th business day of the month prior, 3 days before the 25th business day. But that's on a Friday, so it actually will terminate Tuesday, tomorrow, this week. So the idea of what fell was these really short-dated contracts, or oil for delivery, fundamentally soon. So this front month oil, June oil is still the month later here is still trading at $20. So we saw these front month contracts decline, but to zero and negative, but not the outer months, not the June months. So the question is, all right, well, why? And the answer is. So there's the termination of trading. So the idea is if you're holding this CL contract, if you're on the long side, after terminating for trading, they're going to be assigned, right? So you're going to actually have to take physical delivery, and if you're on the short side, you're going to actually have to deliver. And what's also going on in the background is there's a nominations process for scheduling, storage, and pipelines. So the idea here is you can't take delivery and then, I can't say I'm going to take delivery. The termination of trading is 4/21, but the actual delivery is sometime in May. So you can't just kind of decide when you get the oil. Well, I'll figure it out later. So what actually happens is right now you schedule your storage and transportation of your oil through the pipeline network. So the idea is what's going on is people are saying, oh geez, right? There's no storage and there's no transportation, right? So so there's nothing to do with this oil, and hence the oil is dropping so dramatically. So why that can't happen is, well, it's the question has a sort of faulty premise. Could we, or not a faulty premise, but the idea is the answer would be is we can't store it. That's the whole reason that oil price is declining. That's why people who are on the long side of this contract going, I can't take delivery, there's nothing I can do with this, I'll get out I'll sell, I'll get out at any price, right? Specifically because, what's going on again now is the nomination process, nominations by Friday, and they're realizing there is no storage. So unless you had some sort of, which, no one has, unless, you could be an anomaly and actually have storage, then possibly, but there's no way an institution is going to sit here and say, okay, well, I'll pay for storage, right? That's it's taken. Right? So now one thing I didn't mention, I don't know if I mentioned up front. Keep in mind, if you're a small speculator, your brokerage account will not allow you to take assignment, right? So it will close you out of this contract. So one, if you're a small speculator, there is no option to take delivery, right? If you're an institutional investor, then you could optionally take delivery. But for even institutions, they're realizing now there's no place to store it, so that's why the price is so low. So there is no way to profit off of it, right? Now I don't know if I mentioned, but keep in mind with the CL contract, right? This delivers here in Cushing, Oklahoma, and where it's delivered is to Enterprise or Enbridge storage facility in Cushing. So the idea here is that when you're looking at this contract, you're sitting there going, okay, well, there's particular delivery points where I can deliver this in Cushing, and those are full, and there's no way to transport it out. Hence, the price falls. So that's why you couldn't sit there and profit off this. It's the very reason that the contract fell so much. Interestingly enough, it looks like somebody may have. The interesting thing here is Most of these, there's actually quite a few contracts still outstanding, open interest that might be assigned for the May 2020 CL contract. So it looks like somebody may have made a quite substantial profit by realizing that if I sell this oil and I don't close out my position, then I'll fill up storage, and then anybody on the long side will just sell at any price to get out because they have nowhere to put it. Meaning somebody on the short it looks maybe possibly did like a sort of a reverse cornering of the market. Or here it's just cornering at the little margin of the market simply because the storage is so full. So somebody may have profited off of this, but there's no way now to buy it up, and because you just can't get storage. Last thing I'll say about this is one other thing that's interesting is the May 2020 CL contract. That's the one that printed. That's termination of trading tomorrow, went down to 1 cent today. But the June contract is trading for $20. However, there are 50-cent put options struck at 50 cents that are now, last look about a couple minutes ago, that were bid at 20 cents with an ask of 25. So there are people right now betting that we're going to see the same thing. That's substantial. The price is 20 now, and the 50-cent puts are bid at 20 cents. So there's people betting that we're going to see this again in June. So I guess stay tuned. Have a great evening. One quick thing I wanted to mention that I forgot to there, just a little terminology and a little bit of background about the market, is the May crude oil traded on the CME is often called paper barrels. And this is why when I say there's 100,000 contracts still outstanding, usually these contracts are 90, 95 of these contracts are closed out prior to the termination of trading, meaning they're used to hedge, but very few actually take delivery. So it looks like some people are more than usual are saying, I would like to deliver, right? So that's, so the idea here is, and you'll hear those terms, the CME oil will be paper barrels as opposed to something like if the oil is going to be physically delivered, sometimes it's called, once it's assigned, it'll be called dated oil, or if it's Brent North Sea, it'll be called wet oil. So that's an important thing to know to understand my comment about open interest. Usually, much of this is closed out, but some people are holding it open, and that might be causing a scramble for storage.